When you hear the name Warren Buffett, you think success, right? The undisputed master of investing. But what happens when the master has a truly terrible year? Okay, we're going to dive into his 1999 letter to shareholders. It's an absolute masterclass in accountability, written right at the peak of the dot-com bubble. So just how bad was it? Well, in 1999, Berkshire Hathaway's per-share book value grew by a tiny, minuscule 0.5%. For an investor who had been compounding money at 24% a year for 35 years, this was an absolute disaster. Meanwhile, the S&P 500 was just soaring. But this is where it gets really interesting. Instead of making excuses, Buffett does this. He takes full, complete, and even humorous responsibility. You see, this letter isn't just about a bad year. It's about the timeless principles that guide a business through thick and thin. All right, so let's break down exactly what went wrong, and let's hear it straight from the man himself. He points the finger squarely at himself, specifically for his performance in allocating capital, and calls out the awful results of Berkshire's stock portfolio. While everyone else was chasing dot-com rockets, Buffett's trusted, long-term companies were stumbling. He just admits it, he owns it, and he literally gives himself a D. Now, to really understand how Berkshire can take a punch like this and keep going, we have to look under the hood. We need to look at its engine room, which is powered by one of the most powerful and, honestly, most misunderstood concepts in finance: floats. Think about it like this. In his insurance businesses, Buffett collects all the premiums from customers up front, but he only pays out claims later, and sometimes many years later. Imagine you pay your car insurance for the whole year today, right? The insurance company holds onto your money, but they might not have to pay out a claim for months, if ever. That cash they get to use in the meantime, that is float. It's basically a giant interest-free loan from his customers. And just look at the staggering scale of its growth. I mean, from just $20 million in 1967 to over $25 billion by 1999. This isn't just a pile of cash. It's this immense, constantly regenerating source of investment capital that gives Berkshire its incredible power. So here's the magic trick. As long as the insurance businesses are run well, this float costs very little, or sometimes it's even profitable. So for decades, Buffett was essentially being paid to hold billions and billions of dollars of other people's money. I mean, that is an almost unbeatable advantage. But Berkshire isn't just some cold financial machine. Its second pillar is a deeply human one. It's a unique management culture built on radical trust. I mean, think about how different this is from a typical corporation. Buffett buys great businesses run by great managers, and then he gets out of the way. He simply asks them to act like owners for the long haul. That's it. That is the entire management philosophy right there. And this next story just brilliantly illustrates how powerful that philosophy is. It's about a furniture company Berkshire owned called R.C. Willey and its CEO, Bill Child, who wanted to expand into a new state. So here's the situation. Bill's stores were never open on Sunday because of his religious beliefs, and Buffett was a little skeptical that would work in a new market. So Bill Child makes this incredible offer. He says he will personally fund the entire $9 million project. If it succeeds, he'll sell it to Berkshire at cost. If it fails, he will personally eat the entire loss. Berkshire wouldn't have to risk a single penny. And the result? The store was a smash hit. True to his word, Bill sold it to Berkshire for his exact cost, and he even refused to be paid interest for the millions of his own money that he had tied up for 2 years. This is the kind of integrity and partnership that a culture of pure trust creates. It's incredible. Okay, so this brings us to the third pillar, and it's the very reason Berkshire underperformed in 1999, Buffett's famously disciplined investment philosophy. While the entire world was going absolutely wild for any company with a .com at the end of its name, Buffett stayed out. Why? Because he didn't understand them. He famously talks about a circle of competence and openly admits that high-tech, fast-changing industries are simply outside of his. This slide just shows the stark difference in mindset, doesn't it? On one side, you have the market in 1999 chasing speculative stories in what Buffett called an enchanted market. And on the other, you have Buffett sticking to what he knew: wonderful, understandable businesses, even if their stock prices seemed a little high at the moment. He was choosing quality over hype. As the mania just grew and grew, Buffett quoted this old song lyric: It was basically his way of saying that trying to explain or justify the wild valuations of the dot-com bubble was a fool's errand. He'd much rather be wrong for the right reasons than get lucky for the wrong ones. So after this whole tour of failure, finance, and philosophy, what's the big takeaway here? Buffett argues that when you're faced with market volatility, short-term earnings, even your own mistakes, there's only one North Star that an investor should ever follow. And that is intrinsic value. It's not the stock price that bounces around every single day. It's the underlying fundamental worth of a business, what it would truly be worth to a private owner. His goal, above all else, is to buy assets for less than their intrinsic value and then watch that value grow over time. And this final quote just sums it all up perfectly. Quality first, always. It's so much better to pay a fair price for a wonderful company than a wonderful price for a mediocre company. In his worst year, Buffett didn't just explain what went wrong, he reminded everyone what truly matters for long-term success. So the real question is, in our own decisions, are we focused on the daily stock price, or are we focused on the enduring value of the business itself?